A note before you listen. BusinessDesk reached out to Duval founder Kenyon Clarke several times to ask him and his wife Charlotte Clarke to participate in this podcast. While those requests were declined by the Clarkes, they did tell us that the allegations made in this podcast are factually and legally incorrect. At the time of publication, New Zealand's markets regulator, the Financial Markets Authority, continues to investigate the Duval Group, and to date, no charges have been laid. Our invitation for the Clarkes to talk to us and share their side of the story remains open.
New Zealanders love property.
I'm in New Zealand, taking you to explore some of the country's most stunning locations.
I'm kind of a bit in shock. Can you imagine living here? Is this now the forever home?
Yeah,
Yeah,
definitely.
3 of the top 5 most watched TV shows are all about best homes, grand designs, and even moving houses.
It's a journey that can be fraught with anxiety. What's that? Pressure.
There's only inches in it, the
Oh my gosh.
And stress.
Is all the trucking, trauma and tension really worth it?
They reach audiences that consistently hit the 500,000 mark. Real estate websites attract millions of visits every month, and every day people are scrolling through properties listed on Trade Me. It's become a common pastime for many. Property is a national obsession, often a topic of conversation. It holds a special place in our hearts and psyche. So it's not surprising that when it comes to investments, we might view it with rose-tinted glasses. Are Kiwis destined to keep repeating the same property investment mistakes, to be seduced almost seasonally by high-return, high-risk schemes promising financial freedom? Or does a tech-savvy, social media sceptical new generation offer hope that the cycle can be broken? We've been aiming to open Kiwis' eyes to the precariousness of unregulated schemes like Duval and get them to cast their gaze further to other investment horizons. But is the pull of property too strong?
You accept information that confirms what you think you know, even if what you think you know is wrong. So there's stuff like that going on, and there's familiarity bias. You invest in what you know. Oh, I know property, therefore I'll invest in it.
I've owned a house, so therefore...
I've owned a house, therefore I know everything.
Even though they may still think it's safe as houses, are younger investors getting wise to the facades of affluence put up by some promoters of property schemes?
Having the need to flaunt their wealth that hard could be a red flag, because it shows that all the good things aren't in their work.
And is there any hope for Duval investors owed millions?
I wouldn't say it's a good sign that a company that you've invested in is subject to statutory management.
I'm Maria Slade, and this is The Love Affair, Episode 5 of The Fall of the House of Du Val. Dean Anderson tears his hair out that younger people are not learning the lessons of their forefathers and mothers. As the founder of wealth management firm Kernel Wealth, he sees how high returns from property remain a national obsession, and that even the Sharesies generation is fixated on yields or returns now, rather than future growth.
I see people posting on Instagram at 18 years old, celebrating dividends, and they're 18 years old, and it's like, that's not necessarily the thing that you want again. Like, why are 18-year-olds having conversations about dividends and yield? Like, it has already passed through to the next generation.
There's one way to test this theory out. We round up some first-year university students and get them into a studio for a little social experiment.
Sweet. Well, my name is Luca Armitage. I study at Otago University. I do law and finance first year, and we're hoping to make it in the second year.
Hi, I'm Dylan Peacock. I study law and global studies at the University of Auckland, and I just finished my first year.
My name is Harry Smart. I'm going to Canterbury next year for second year engineering.
I'm Cleo. I study a BCom at the University of Auckland, majoring in marketing.
University challenge this is not. But we are keen to hear whether Dean is right, that these youngsters want it all and they want it now, or if there's hope the next generation is more financially literate. Full disclosure, Harry Smart is producer Hamish's son, And Cleo Yee is executive producer Jane Yee's niece. Did we mention this is an unscientific experiment? All we tell our students is that we're making a podcast about a financial investment and what we can learn from it, and we want their reaction to the various features of the scheme. I begin by asking if they've had any experience with investing.
I've done limited investing with like day trading, just investing into stocks, taking it out like a few weeks later after it's gone up a bit, as well as like I invested into crypto a few years back, made a couple hundred off that, Bitcoin, Ethereum, Ripple, pretty limited, but I've had good fun with it.
Okay, flying start. However, I'm sure Luca is not telling us about his losses. As we keep chatting, it emerges Dylan, Harry and Cleo know more than they think.
I haven't invested before. I haven't really caught an interest in it. That may change, but at the moment, yeah.
I just put a couple $100 a week into index funds with Sharesies.
I've never really known about anything to do with investing, so I've never gotten into it, but maybe we'll learn in the future.
Have you got KiwiSaver?
Yes.
Okay.
That's the only thing I know.
All right, well, that's investing.
I don't know much about it, but as soon as I realised that you can use it for your first house, I changed it from 3% to 10% at my workplace.
It's clear these young people are already streets ahead in the financial literacy stakes than Hamish, Jane or I were at their age. Given they were also more or less born with a smartphone in their hand, when I ask how they react to an ad on social media for a financial product, Luca in particular doesn't suffer fools.
Ooh, well, it'd have to catch my eye somehow. Like, I see so many ads on a day-to-day basis that I've just kind of been attuned to ignore them. And that's the same with, like, investment ads. Like, I get heaps because, like, I have been interested in investing. And, like, when I look at them, I'm not generally that interested unless they have something to offer me that competitors won't offer.
So you understand that you're being targeted by those ads?
Oh, definitely, yeah. Like, you can tell by what ads you're getting day to day.
Even if someone promoting an investment has thousands of followers and the Instagram blue tick of verification, Luca's cohort are well aware not everything is as it seems.
It's getting harder and harder as like you can say that like, oh, I have a high Instagram following, like people, I've trusted customers with it, but they could all be bots. Like in this day and age with AI like coming up and everything, it's much easier to fake legitimacy.
What about you, Cleo? If you saw an ad on, I don't know, Instagram for a financial product, what would you think?
Well, it would definitely catch my eye because a lot of my ads are just clothing and a lot of makeup and just stuff I'm interested in. So it would definitely catch my eye. But I think what would really draw me in is knowing big brands because there are so many scams that I'd have to really trust the brand.
I asked them how they'd react if that investment was offering a 10% return. Harry and Luca aren't put off, but they are sceptical.
The return like 10% if it's not over the span of like a year with an index fund or something like that, then I'd be very careful with the risk.
Yeah, generally high return correlates to high risk, and so over a shorter period of time you'd be risking more and it'd probably be a bit dodgier.
I think in general if something looks too good to be true, it usually is.
But when it comes to the subject of property, Dean Anderson may well be vindicated. What if that investment was in property? Would you feel any different, any of you?
Well, I'd probably feel a bit safe about it. The property market's like one of the most trustworthy markets out there. It fluctuates with the economy, obviously, as property prices go up and down. I'd say like Auckland has a very strong property market. Like property value is very high here. But generally I'd say, okay, it's going to be safer unless there's a massive shift.
Dylan chips in here.
I think it would depend where it is. Like in Auckland, if I can go see what I'm investing in or I can understand it, then I think it would be a lot better for me.
So it would make you feel a little bit different if that it's in property, a little bit safer.
Yeah, for sure.
What about you guys? How would you feel?
It would definitely make me feel that it's safer, but I also think property is a big investment that you're making, and it's not something you can easily take money in and out of. So I'd want to do a lot of looking into the property, the area, the location, all of that, yeah.
Yeah, no, absolutely the same. They basically said it all.
So that's a big tick for property. Dean's also proved right about their preference for income now, rather than waiting for future growth. Luca and Harry speak for the group.
At the moment, as a first-year uni student, I don't have access to a lot of money, especially in Dunners, where there's no job market. Money's scarce over here. So if I'm going into an investment and it's going to be long-term, I don't have to be down on my ass for a while, unable to afford basic living costs, all that sort of stuff. So it really comes down to who you are.
I agree with these guys. I wouldn't put my money into a super long-term investment right now. I'd rather have just short-term gains.
The boys also back themselves to wrangle an unregulated wholesale investment.
It'll definitely feel more risky, but I think if I learn and understand what they're doing and I see the results by people and through more research, it could be definitely worth the risk. But at the same time, it's just a risky business, so I'd have to be absolutely sure. And
I definitely agree with Dylan Peacock over here. I would be more skeptical, but I think by the point that I've done enough research to even put my money into an investment like that, it doesn't play as big of a factor.
What about you, Luca?
Yeah, I mean, I agree with these boys. At the end of the day, it's up to you to do your own research when it comes to your money, because people want to take it from you, but people can also help you earn money if they benefit from it too.
But when I ask how they'd feel if the investment company founders were big noting and flashing their wealth around town, the first year uni jury is out. Dylan ponders.
I mean, it would be impressive, but I think I'd still be a bit skeptical because there's loads of people around the world that live outside their means. They take loans to buy nice houses, they take loans to buy nice cars. So it doesn't necessarily mean that they're actually really wealthy, but I want to do more research for sure.
Remember, at this point, our students still don't know what financial product we're talking about. I pick it up with Harry and Cleo. So the very fact that these people are promoting themselves in that way, making themselves look very wealthy or, showing off their wealth, that in itself wouldn't make you think, why do they need to do that?
I don't think it's necessarily a big red flag that people are flaunting their wealth. It's quite natural to want to do. But I definitely wouldn't trust it extremely.
Mm. I don't think that I would assume that they're the best because they promote themselves so highly. I think that definitely doing research on other people, not on just their wealth, but their knowledge as well, and getting to know them on a more personal level to find out what they're about and their passion rather than just choosing based off their overall image.
To play devil's advocate, though, I think having the need to flaunt their wealth that hard could be a red flag.
Yeah.
Because it shows that maybe all the good things aren't in their work.
I ask them how they'd feel if the company they're considering investing in recommends a lawyer or accountant to go to for advice. In earlier episodes, we heard how Duval was accused of getting docile professionals to sign eligibility certificates for investors, and how the blue chip property scheme made use of tame lawyers. This one does not get past Harry, Luca or Cleo.
I'd definitely be slightly suspicious
Yeah.
and prefer to use my own lawyer or accountant,
Yeah.
not going through that company.
Yeah, I want to proffer the idea of using my own lawyer and see how they'd react.
Yeah. Definitely want to double check that.
Yeah.
Would you agree, Cleo?
Yeah, I absolutely agree. Just not being peer pressured into anything and just holding your own, standing for yourself. And
so this falls into the red flag category big time for you guys?
Yes.
Yeah, yeah.
Unlike many of the people you may have followed online, I can talk you through what it takes to build a $100 million or $1 billion business and property investment empire because I've done it.
I reveal to our student panel that we've been talking about Duval, in statutory management owing an estimated $268 million. And they look at me blankly, because it turns out teenagers are not big readers of the mainstream business media. Hindsight's 2020. And hearing these factors laid out after the fact causes Luca and Harry to reflect.
One final thought about red flags and green flags and everything. Looking at a company, looking at investment opportunity. If I see a red flag, I can look past it. But if I see another red flag and they keep building up and up and up, it gets to a point where I can't have confidence in that investment, and I just want to leave it be and look for better opportunities.
Yeah, I agree with Luca. I think aside from the lawyer accountant one, none of those are super, super major red flags.
Yeah.
But when they all compound together, it's okay, come on.
Okay, so if you added up that ledger, you might think,
okay, flaunting the money, and then the lawyer accountant, and then all the other stuff.
Yeah, and then unregulated. It gets to a point where you're taking the piss.
Yeah.
That is a great line.
It's a great line. You might think after the spectacular collapse of Duval that rules would be changed to crack down on high-risk, unregulated property investments being marketed as retail products. But on that front, there's tumbleweed in the corridors of power. Just a few weeks before we launch this podcast, the Financial Markets Authority, the FMA, warns yet another provider. It pings it for misleading the public and using Google Ads, or AdWords as it was known, to inappropriately target ordinary Kiwis. The firm sponsored terms like term deposit and low-risk investment to attract people looking for a low-risk place to put their money and propel its products up the search result rankings. This wild west of online marketing keeps academic Shahil Kishore busy.
Okay, I'm Shahil Kishore. I just recently got my PhD and I'm here as a lecturer at the University of Auckland Business School.
I've spoken to Shahil before about algorithmic targeting, the technical term for what happens when we give our data to the social media platforms, which most of us do with gay abandon. Hamish and I drop into his office in Auckland University's Swish Owen Glen building to get him to explain it in words of one syllable. Essentially, because ads are carefully curated for us among the family reunion pics and kitten videos, we trust them.
So social media has a unique effect on people because it mixes the relationships you have, your friendships, your family, with advertising. One example is you could be scrolling through Instagram, say, and you would see something like an ad, which would say, your friend has liked this page. And that immediately gives you a little bit of, oh, this seems legit. This creates some level of legitimacy around these different types of ads. And so that is totally missing when it comes to traditional formats of advertising, where it's all one directional. Here it's two directional, where we can see our friends and family engaging with ads. We can comment, we can like, we can discuss. And so it really changes the game of advertising.
These platforms are designed to get us to interact with the ads, and Shahil says regulators around the world are struggling with how to deal with it. In a recently released report, the Financial Conduct Authority in the UK looks at how to make sure finfluencers or financial influencers follow consumer protection standards.
I'd say one of the best ideas that I've seen so far is related to the platforms and the design of these platforms, which is, look, advertisers need to have some leeway to do the things that they want to do, especially around innovation and doing good things. But risks should be clear. So if there is a platform out there and an ad, then that ad itself should have a label, a really clear label around what are the risks for a particular ad or the risks around a particular financial product as well. So what we're seeing a lot is they actually truncate the risks. So they shorten the risks. You can't see the full risk until you click on it, but those risks should be upfront for anyone looking at that ad.
He says in terms of the psychology of investing, it's created a whole new realm.
These groups are protecting themselves in a way by saying that they are targeting wholesale investors. But all it takes is a reshare, tagging one of your friends, or putting it into a different group to take that completely outside of the context of wholesale investors to these regular mum and dad investors out there. So social media allows them to kind of hide in a way behind what they are targeting and what they are focusing on, but it's really easy for that to go beyond that group that they're targeting.
Social media works really, really well, and it's basically why so many people trust a finfluencer over a registered financial advisor or even their bank.
So a big issue around this is accessibility. When you're younger and you're growing up, especially this Gen Z group we have from 18 to 25 at this point, they are getting a lot of information from social media. They're getting a lot of the information from these finfluencers. And it's just accessibility, right? It's a 1-minute video where you can get some pretty useful knowledge sometimes versus having to organize and meet with a financial advisor. They're totally different things, totally different levels of the spectrum. You can microdose your learning on these social media platforms and pick up some hints here or there, rather than having to go through all of these formal practices through a financial advisor.
The tech giants have had more or less unfettered reign over the globe to date, and Shahil says New Zealand is well behind the 8 ball in wrangling them.
We are seeing changes and movement in the direction around regulation. For example, the proposed ban of under 16-year-olds that's happening or moving in New Zealand. But in terms of these types of regulations, we are really struggling to play catch up. We're constantly trying to get ahead, but always being pushed back.
So the genie is out of the bottle. And while regulation can be implemented, enforcing it is a different ballgame. And that's where education comes into it. The Retirement Commission's job is to help people improve their financial futures. And if it's a commission, there must be a commissioner. So we figure she's a good person to talk to about how you cultivate Kiwis' financial nous.
I'm Jane Wrightson and I'm the Retirement Commissioner.
So Jane, it's really interesting the way we keep seeing these property schemes popping up over the years. We've had the likes of Blue Chip 20 years ago and, many in between. Why is it do you think New Zealanders keep getting sucked into these things?
It's funny, isn't it? And firstly, you think about those names, they always sound really solid, respectable, internationally competent names, don't they? Blue Chip and Grosvenor and Capital and Merchant and all these big things. And for the ordinary person, it gives them an aura of respectability.
Jane is referring to two finance companies from the 2010s. But as we know, and as she reiterates, property is where New Zealanders' hearts lie.
So property is our favourite asset class here, like shares are in the US and like bonds are in emerging markets, and we default to it. And we default to it because it's always seen in our heads as safe as houses. It just is. And investors can get into trouble particularly if that attitude extends into property development and commercial property. It's a bit like education. We've all been to school, so we've all got an opinion on it.
She says this is where behavioural finance can throw us a few bones, and it's something she's learned a fair bit about on the job. Spoiler alert, human beings are not rational creatures.
And so you see some patterns here. You see herd behaviour. If everybody else is doing it, you've got FOMO, it must be all right. You see self-attribution, overconfidence, in other words. There's an interesting gender lens on that I won't go into, but you can guess where the divide is there. I have more confidence in my ability to understand these things than is possibly necessarily true. You see confirmation bias. You accept information that confirms what you think you know, even if what you think you know is wrong. So there's stuff like that going on. And there's familiarity bias. You invest in what you know. Oh, I know property, therefore I'll invest in it.
I've owned a house, so therefore...
I've owned a house, therefore I know everything.
Jane says it is a two-pronged approach and strong consumer protection regulations are required. But everyone can do with some upskilling, especially when it comes to retirement savings we can ill afford to lose. And it is an ongoing challenge because this is a complex world. So basically we could do with a little bit more regulation in this space, getting the social media providers a little bit more corralled perhaps.
Yeah, well, the world's been trying to regulate Facebook et al. For a long time and not going very well, right? So that's why the education piece is so important, because we can wave our fists at them all we like, but bad operators will continue to operate badly and just be smart about it. And good operators have an opportunity and a challenge ahead of them to go, how do we make our offerings look really good and really strong?
A lesson she really wants people to learn is that property investment is not for the faint-hearted and certainly not for amateurs.
This is the eggs in one basket problem, isn't it? So there are so many stories of people getting wealthy on property, every bloody time. They all talk about how fabulous it is. There aren't many stories of people who crash and burn or who lose their shirt and the rest of it.
Commissioner Jane has come up with her 5 golden rules for mum and dad property investors. She says these are issues that those who fancy themselves as property tycoons fundamentally and perennially fail to understand. Here we go. Rule number 1. Beware lack of diversification.
So you're investing in a single company's project or a single asset class, a single industry, or even a single country. It doesn't protect investor money in a way that avoids having too many eggs in one basket. So it should be property plus, not just property. And how much proportion of property? Again, you need advisors to talk you through, and that will be about risk.
Rule number 2. Property is illiquid. In other words, you can't cash it up in a hurry.
They're tied up in long-term property developments with no guaranteed timeline and no mechanism for withdrawal. So, hard. That's why it might be 10%. There's a lot of risk attached to this.
Number 3. Property development comes with a lot of debt.
I don't think people understand how much the property business relies on borrowing, which means you've got high leverage, exposure to debt. You need to understand that increases the risk of default if projects underperform or market conditions change. And we're seeing that now, right? The building industry is really constricting now, mostly because of partly the recession and partly because change of government priority. And goodness me, I would have said not very many years ago, fantastic industry to be involved in. But we're going through another surfing of the wave, right?
Property investments often come with very little protection.
The fourth thing is that everyday investors don't understand that they're not as protected in these investments as they would be in, say, KiwiSaver. So they're marketed as wholesale, But many investors are not financially sophisticated. I'm the same. I would never go anywhere near anything marked wholesale because I don't know enough. I need advice on this. And so if it's a wholesale investment marketed to the general public, you need clear warnings, and they're not always there, that such offers are not subject to the same consumer protections as retail investments. And there's not the same traditional regulatory oversight. Do you know that? Of course you don't. Got to do a lot of fine print reading to understand that.
Big returns mean big risk.
And fifthly, I just don't think we grasp how inherently risky property development is. We don't think it is, because generally we only see the success stories, and it seems less risky than shares sometimes. Those people who were burnt in 87 or the 90s, we've all been there. But they don't understand how risky it is. It's subject to delays, it's subject to cost overruns, it's subject to market downturn, which, impacts on returns and leads to losses. So this is not a perfect world.
The Duval saga is far from over, and as we record this episode, it's unclear how or when it will end. Statutory Managers PwC's latest report shows the group owes $268 million to lenders, the IRD, subcontractors and investors. Over 100 investors in the Duval mortgage and opportunity funds, including Malcolm Forsyth and Kate, who we spoke to in episodes 1 and 2, are owed $54 million, not including the interest they should have earned, and are unlikely to get anything. There is also little hope that unsecured creditors, people like tradies and other suppliers, will be paid any of the $9.5 million they're owed. Another 30 investors in the Build to Rent fund are likely to fare better, recovering around $4 million of the $10 million they're owed. The Financial Markets Authority, the FMA, continues to investigate the group. But Duval co-founder Kenyon Clarke is unequivocal that it is the regulators who are to blame for the collapse. As we've said, Kenyon would not be interviewed for this series, but of his own accord, he provided us with a set of audio recordings. And here's how he describes matters.
Duval was a $600 million trading developer with a track record second to none, appropriately sized for a tougher market, not a distressed business. We had the full support of our shareholders and our lenders. There was no market failure. I repeat, there was no market failure. The FMA and PwC have created a financial train wreck.
He says, "This is the type of thing you expect to see in North Korea, not in New Zealand, and it should alarm every business owner in this country." He regularly counts off the days since the August 2024 raid on his home without charges being laid. Here he is on October 9th.
To my knowledge, and 616 days into a stalled investigation, no evidence has been provided to me or to the courts to justify the actions taken by the FMA.
Although there are no charges thus far, seizing someone's assets and putting a business into statutory management takes up plenty of court time, and I have a file bursting with legal documents. The case is officially called the Financial Markets Authority and Duval Capital Partners. But the first 6 pages of each of these documents are taken up with listing the names of the parties, because there are no less than 70 Duval entities in statutory management. Another 8 are in receivership, including the Clarkes themselves and their family trust. We went looking for someone to explain statutory management, but because it's so rarely used, people who've experienced it are a bit like the unicorns of the insolvency world. Lucky for us, up on Auckland's Legal Row, Shortland Street, we found one.
So I'm Matt Kersey, I'm a partner at Russell McVeigh. I am a specialist in insolvency and restructuring.
Matt Kersey was involved in the South Canterbury finance collapse 15 years ago. He acted for the group's founder, Alan Hubbard, and his wife, Jean, who were personally put into statutory management, along with their entity, Aorangi Securities. Matt says it is the most extraordinary and powerful type of insolvency process.
What is it? Well, probably to the general public it would sort of look and feel a bit like a liquidation. You have an insolvency practitioner appointed to control the company, but it happens by government decree rather than by private law or court process. There's a series of analyses and reports and decisions which ultimately end up with the Governor-General making the appointment rather than, say, the court or the board of the company or the shareholders. The government steps in and says this is a process that needs to happen in this particular rare circumstance. And it is recognised as a remedy that's only really should be used in the most extreme of cases or most complex of cases.
It can happen quickly if the situation is seen as urgent, and it usually involves something of scale. The regime trumps all other types of insolvency, and it also has protective elements.
The statutory managers have very broad powers. They have many of the powers of a liquidator, plus some, and they're all set out in the Act. And it's designed with very large-scale, complex distress in mind, which might not necessarily be genuine insolvency, but if you could imagine, it would be something that could be used on an airline or a registered bank or a large insurer to try and protect the entity and allow a more stable way of reorganising the entity. So it has these sort of unique features that you don't find with other insolvency processes.
Fun fact, there was another less well-known statutory management in between South Canterbury Finance and Duval. In 2010, it was used to manage 2 subsidiaries of IHC New Zealand to ensure continuity of care for 2,700 intellectually disabled people. But generally speaking, it is an extreme remedy and only intended to apply when all other processes are deemed inadequate, which Matt says is a high bar. I ask if it can mean a better outcome for investors. He says, in theory, yes, if it can help to keep everything together and protected.
But I would probably say that if you've made an investment in something that is the subject of statutory management, then there are some pretty severe and serious issues with it. So I wouldn't say it's a good sign that a company that you've invested in is subject to statutory management.
The outlook for Duval investors is bleak. It's unclear at this stage whether anyone will be held to account for the losses or if the authorities will get to the bottom of what happened. It's important that lessons are learned from the Duval story because, in Kenyon's own words, we haven't seen the last of the Clarkes. Here he is in the final audio clip he supplied to us.
Well, I've been beaten many times. I've never been defeated. Strap in, round 2 of 12 is about to begin.
This was The Fall of the House of Du Val. The Fall of the House of Duval is researched, written and hosted by me, Maria Slade. It's produced by Hamish Williams, with sound design by Mick Andrews and editing assistance from Lara Healy. Our executive producers are Duncan Bridgman and Jane Yee. Special thanks to Victoria Young, Garth Bray, Ethan Sills and Isabella Iramia. The Fall of the House of Duval is a Business Desk production for NZME, with support of the Milford Foundation's Brian Gaynor Business Journalism Initiative and MoneyHub. For more on the developing Duval story, visit businessdesk.co.nz.